Hi, good afternoon, everyone. I think we're a couple of minutes early, but I've got loads of stuff to talk to you all about, so let's crack on. Got a couple of people just coming in. You won't need the coffees, it'll be exciting, don't worry. Money back guarantee. Oh no, hang on, no, don't do that. So I'm here today to talk about P11ds and self-assessments and pitfalls and planning opportunities. Just to introduce myself, I'm Alan Sowden. I'm the Technical Director at Chapman Robinson & Moore, a firm of accountants based just north of Oxford in Kidlington. Two very big topics. I could speak for hours about each of them. I've not been asked to do that, luckily. So I'm just going to focus on some main sort of key common points and planning areas. Also point out, obviously with recent political events, last year's or this year's finance, I'm not commenting on them. But the Finance Act for 2017 got rushed through, and what happens in these circumstances is huge amounts of the budget gets dropped to get the Act through before Parliament starts. So there's a little bit of uncertainty when we're talking about forward planning, whether rules that were in the budget will in fact now go through a revised Queen's speech. Normally it's a bit of a formality, but obviously this year, who knows with anything. So moving swiftly on, we'll make a start on P11ds and then move on to self-assessments. So start with some admin basics. So they need to be filed by the 6th of July, so we're in prime filing season now. No P9D this year. First year I've had no P9D. Hands up if you've ever done a P9D. One. There we go. You're one ahead of me. I've never done one. Didn't know they really existed. I thought it was just something for exams. But they don't exist anymore anyway. By the same date, we have to give employees a copy of their P11D. And by the 22nd of July, we have to pay the Class 1A, or the 19th of July if we've got anyone who pays by cheque, which you probably haven't. NA if benefits are payrolled, which I think has been covered by roll pay this morning. So for payroll and benefits this year, you don't have to report them on a P11D. In fact, you shouldn't. And you can do a nil declaration as a handy link there, which you'll all commit to memory now. There we go. Right. Worth pointing out, there are some non-taxable benefits in kind. The annual Christmas party and annual functions costing up to £150 per head per annum. That's a cumulative total. And each function is all or nothing. If it costs you £100 a head for the first party, and then £60 a head for the second one's taxable in full. You include the guest in the head count. So it's not per employee, it's per guest. So if you've got partners and other people come in, just divide the total cost by that number. It's simple as that. One mobile phone per employee in the name of the company. Can't underline that one enough. Huge difference. Many things in tax between the company contracting with whoever your provider is for a phone, providing it free of charge, no taxable benefit, slight VAT tweak. Company pays for employee's own mobile phone. Huge difference. So in that case, what you're looking for is a reportable benefit in kind and being subject to Class 1 NIC. So it's the worst of both worlds. You've got to do payroll for Class 1, P11D for tax purposes, get the contract right in the first place, completely exempt from tax and NI. So you get same basic principle, very different outcome. And we see this as a recurring theme. So always important to get the contract with the company and the provider. So I've already covered that. Childcare vouchers is something which is due to change early in 2017. I don't know when early in 2017 stops, but we're nearly halfway through it. People will probably be familiar with the fact that you've got a limit for basic rate taxpayers, which is then halved for higher rate taxpayers and reduced even further for additional rate taxpayers. Principle being everyone gets the same amount of tax relief. Now, what you count as income as the employer is just the pay as you earn and benefit in kind amount. So we don't include dividends, rent and interest. So if you've got a director who's got a salary of £10,000, no benefits in kind, dividends of £100,000, he's a basic rate taxpayer and he can get the full amount of childcare vouchers. So it's a nice little point. Annual health screening and medical checkups, tax-free, again, important. The company contracts with the healthcare provider. If you just reimburse your employee or pay or settle their contracts, very different treatment from tax purposes. And trivial benefits. The classic turkey at Christmas is the example they still use. I tried to come up with different faith versions in our team meeting on this, and I struggled. So I don't know. I mean, you can't really. But yeah, but basically we've got a limit of, it's just what comes out, £50 monetary value, but not cash or cash equivalents. That's things like M&S vouchers, any other vouchers, Amazon vouchers, and also something that's not contractual. So if someone's got a contractual right to a turkey at Christmas, it becomes taxable. So I don't make the law up, I'll just tell you about it. Car and fuel, is it worth it? Especially fuel. The tax goes up and up and up. If it's not a company car, it's not company fuel, educating clients is the biggest thing, because you know, we all know it. The client, you told them they've got to pay mileage, and then you see a fuel bill go through. Now, technically speaking, as soon as the company's paid that fuel bill, you've got a car fuel benefit for the whole year. So must be dealt with and pushed to the director's loan account, and the client slapped around the head multiple times. Where you have got someone who's doing AMAPs, used to be fixed profit car scheme, AMAP payments, they're 45p a mile up to 10,000 miles, etc. You can reclaim VAT on the fuel element of that, and how much of the 45p that is depends on the type of fuel and the size of engine, and that varies with what's called the fuel-only mileage rates, which get updated each quarter by HMRC. And quick plug, we always put them on our website, crmoxford.co.uk. Remember the diesel surcharge still exists. It was due to disappear, and then it didn't, so that can bring your baseline benefit in kind up by 3% to an overall limit of 37% still. Make sure you get the correct CO2. The client will never give you this. It's on the logbook, but if you haven't got the logbook, this website here, literally all you need is the registration number, and it will tell you the exact CO2 emissions of that particular car. So that's really handy. And make sure you use the list price when new, not the amount the client paid for it, even if it was brand new. Because the dealers always charge far less, or normally charge far less, than the list price, but it's the list price when new, which is taxable. Just going back to this first point about is it worth it, especially fuel, the answer, the example I always give, and my notes are over there, so I can't quite read them, is with my car, which is nothing flash. CO2's 140 odd grams of CO2 per kilometre, and it's a diesel, so you get 3% surcharge. The benefit in kind, if I had fuel provided for my car, would be about £2,500 a year, which, if you're a high rate taxpayer, works out to around £50 a week in tax, and I put about £50 a month of fuel into my car. So that's how not worth it for me that fuel benefit would be. It would cost me 4 times in tax what I actually pay in fuel, and the company's still got to pay for the fuel. So, you know, do the maths, and I've had clients like in the exact same circumstance, and they say they can't be bothered to claim back the mileage, but they're still better off just to pay all the fuel themselves and not pay the tax. This is something very few people do. Capital contribution. A good way of doing this is with a dividend. So declare a dividend up to £5,000. Why is it £5,000? Don't know, that's just the law. So by way of an example, we've got a £30,000 list price car, and we're going to contribute £5,000 by way of declaring a dividend. So the director doesn't have to write a cheque out. He's just going to put some of his income, not draw it out, goes into the car. Keeps the car 3 years. So this saves a benefit in kind of, so I've got the workings are kind of there behind it, 28% benefit in kind this year. Obviously it goes up and up and up every year, which takes me back to my point about is it worthwhile. Benefit in kind there, £4,500 saves. For a basic rate taxpayer, £900 tax plus 621 Class 1A versus the £375 the dividend costs them in tax. For higher rate taxpayer, obviously the numbers go up, both the saving and the actual cost. Both times round you can see that is quite a significant outweighing by paying the tax and the dividend in the first place. And you sell the car back for, say, 15 grand after 3 years, you sell it on to deal, however you get rid of it. 5/30ths, i.e. they paid 5 grand out of 30 grand in the first place, so that proportion, 1/6, is due back to the director. So they retain that interest in the capital but don't have to contribute to the running costs. So they get 2.5 grand back, which obviously they can then roll over into the next car. So that's a good little proactive tip for people who do have company cars, where you can potentially save them some tax. Company vans, flat rate benefit in kind with a separate benefit in kind for fuel. Not applicable if you only use it for work, which includes, bizarrely or rarely, not really bizarrely because who really wants to drive a van about, going to and from work, and what they call insignificant private use. And this is some more great examples in HMRC manuals. Insignificant includes, for example, and I quote, taking a mattress to the tip once a year. I don't know what they're doing to their mattresses, but I'm not going to one of HMRC's Christmas parties.
Do you have to keep a log to prove it?
About the mattresses or the journeys? It wouldn't hurt to. You don't have to. The key would be to have either into the employment contract to say that they can't use it privately at all, ideally, or not to be insured. If it is going to be used a little bit, it is... I mean, a log's great. In reality, most people aren't going to do it, particularly most company van drivers. But yeah, if you can get the client to do it, great. Particularly if it's a pool van. So as I just said, avoid having the charge by an explicit agreement signed saying they can't use it privately, or by not insuring it for private use. And technically, you don't have to prove it's not used. You have to prove it's not allowed to be used. Gym membership, private healthcare. So I've got an example here, because obviously your choices are pay it yourself and pay yourself more money, or have it their benefit in kind. And the maths has changed since the new dividend tax has come in. So, assuming we take it to benefit in kind, £1,000 cost, plus the NIC, less the corporation tax. Trust me on the maths, comes to £922. You're going to pay, you can double check this maths, £200 or £400 benefit in kind. Dividend to cover the tax on that is the numbers you see there. So the total cost of providing the £1,000 medical cover becomes £1,138 for a basic rate taxpayer, £1,514 for a higher rate taxpayer. So I've assumed they want to leave themselves, without paying a penny. If they just take a dividend to leave themselves £1,000, the cost is £1,081, £1,481. Very close. It used to be actually slightly close the other way, marginal either way. So we're tempted just to say to people, just pay it personally. Is it really worth it? Particularly if that's the only thing you're doing a P11D for. Is it worth doing P11Ds to actually pay 50 quid more in tax? Discuss. Sorry, I'm flying on because I'm conscious of trying to get through all my slides. Interest-free loans. Overdrawn director's loan accounts is the problem here. We all have them. Client doesn't realise what's their money, what's the company's money. Particularly if they've been a sole trader and incorporated, they've never quite broke the mentality. We've all got them. There's a benefit in kind where there's an overdrawn loan or a genuine loan with interest charged below the official rate of interest, which is 3% now. It was 3.25% previously. It doesn't apply to loans less than £10,000. But to watch out, if it is a director's loan account, there's no £10,000 de minimis for what's called the Section 455. Some people who went to college when I did would call it Section 419. Corporation tax charge to participators. So watch out for that. You've got an overdrawn director's loan account of £8,000. You don't have to worry about the interest, but it does still need to go on the corporation tax return for those people dealing with the corporation tax. So slightly off topic, but it is related. How do you avoid it? By not going overdrawn, which is ideal, or by you can charge the interest. Company charges interest to the director at 3% for the year, and obviously typically it's only got overdrawn through the year. So it could be just as easy to charge the interest. Again, particularly if you've got a situation where P11Ds aren't going to be done otherwise. The danger there is you don't do a P11D, the client eventually gets their final account stuff ready for their March year end. Sometime in August, you've missed the P11D filing deadline. So they're going to have a late charge for their P11Ds. If they charge interest, there's no benefit. So there was no late filings, no filings due. Reimbursed expenses, which probably for most people is the number one thing we used to declare on our P11Ds. Often we'll have used a dispensation to get around having to report those, which would have been HMRC agreeing that certain amounts paid to certain categories of employee were exempt. They've disappeared from April 16, but there's a statutory exemption for which deduction is available. So that is for the fellow geeks amongst us here. Section 289A of ITPA 2003 The reason I tell you that, I don't normally give statutory references, is it tells you quite clearly what the rules are. But in a nutshell, not part of a salary sacrifice arrangement, which it would be quite rare. This is kind of employment agencies were doing this, saying, we'll reduce your hourly rate and pay some travelling expenses, bit dodgy. A deduction for expenses available for the employee. So what this is trying to do is get around this stupid thing where we used to have to report on a P11D some expenses payments, and the employee would have to send in a section 336 or whatever it is claim to offset that. So it's actually a little bit of common sense law. So as long as it is not part of a salary sacrifice agreement, there will be a deduction available, i.e. it's wholly, exclusively and necessarily incurred in the conduct of their employment, and it's calculated and paid in an approved way, which basically means you're actually reimbursing a real cost, or it's an approved scale rate, and there's a system in place for checking expenses incurred and deductible. So for one-man companies, or for the boss, or the person who's dealing with this could be you. It doesn't have to be an employee, but this is part of our value offering as bookkeepers and accountants. So actually we can be the person checking this, and that then means that you can claim this exemption. If I don't check it, you can't claim the exemption, you still have to report the expenses. Again, little link here at the bottom that gives us the guidance in exactly how these exemptions apply. And I can barely read that from here, to be fair. I'll read this out. I couldn't work out how to make the picture bigger on PowerPoint, I'll be honest. If you've got a 5-hour journey, and when by journey it doesn't mean literally you're travelling for 5 hours, but you're you're on site or away from home for 5 hours or more, you can pay up to £5. For a 10-hour away, you can have £10, and for 15 hours or ongoing at 8 p.m, £25. So what this is for saying to someone, rather than give me the receipt for your lunch, we'll just pay you a £5 if you're out for the day, a tenner if you're out for a long day, or £25 basically if you're away overnight. You can apply for a bespoke rate. So the conditions are, must be a qualifying journey, i.e. the travel must count as travelling, so it's a temporary workplace, and the employee must incur a cost and keep receipts. They don't have to give the employer receipts, but they must have them. They don't have to incur £5 worth of cost for their lunch, but they have to incur a cost, so even if it's a quid or whatever. You can still give people pies. I know some of us may have had them at lunch. Different sort of pies, personal incidental expenses, £5 a night in the UK, £10 a night overseas. It's just on top of actual costs to cover, again, when this legislation came in, it's to cover things like a newspaper, laundry and telephone calls home using the hotel phone. So the law hasn't really moved on with modern life, but that is the law. So what are we on? 10-2, I think we're on track. Okay. Self-assessment. So if we've got time at the end, by the way, I'm happy to take any questions we have. Otherwise, my next session is tax Q&A, so you can always grab me in that one. So a lot of people have employment or pension income. So as well as the P60, if we've got an unusual tax code, I would always say to get a copy of the coding notice, and that's the employee copy showing the breakdown of how they've arrived at, 850T or something. The key reason being, one, there might be a source of income that we don't know about, and that would be picked up from the coding notice, but possibly there could be tax from a previous year in that coding notice, which we've got to allow for in this year's tax return. It'll also allow you to explain to your client why they've either got a tax liability or a tax repayment due. So again, you can say, well, there was a £1,000 benefit in kind in your code, but your actual benefit in kind was £1,200, so therefore you owe tax on £200 still, and that's why you owe X amount due by 31st of Jan. State pension. This can often be a problem for people. It's normally paid for weekly. The client normally gives you the monthly amount and times it by 12, so you're always going to be short by 4 weeks' worth. To make matters worse, the first payment in the tax year normally relates to the previous tax year. So some clients will add up what they've got, so it's a bit more accurate, but then they've got one at a slightly lower rate than the other. State pension is taxed on an earned or as due basis rather than an as paid basis. So what the client is paid is not what they're taxed on. So this is marvellous. Best thing to do, check it if you've got the client on your agent login on HMRC, it should in theory, give you that on the information to help me complete my tax return bit. 2 caveats on that. 1, it's not always on there, and 2, it's sometimes wrong. But if you've got the tax code and you've got the HMRC website and it's the number you think it is and it all agrees, you can be quite happy. If one of those is different, you've got to go with your gut, you've got to go with your gut instinct and kind of balance the probabilities and explain to the client how you come up with a number. And I say normally 13 times the regular amount. So someone might give you one smaller amount and then either 11 or 12 bigger amounts. If you take that bigger amount and times it by 13, that should give you the right amount. Often what I find happens is the client gives you their notice from HMRC or from the DWP for what the next year's is going to be, and might see an obvious thing to say, but just keep hold of it and stick it on the front of the file, because this time next year you'll be wanting that information. If you give it back to the client, I'll guarantee you won't get it back 12 months later. High income child benefit charge. If an individual's got income of over £50,000, we need to be aware of any child benefit paid to the taxpayer or their partner living with them. This can be quite difficult actually, because it's not always, it doesn't have to be the partner's child. So mid-year, someone moves in with someone, they've got a child from a previous relationship, they've got to have quite a candid conversation over the fact, well, I earn over 50 grand and I get child benefit, and therefore I've got to pay that child benefit back through my tax. It can get quite difficult. That's not our problem really. But we just need to be asking the question. So I would say anytime anyone's got income over £50,000, unless you know, for absolute sure they can't possibly have someone in the house and recipient of child benefit, ask the question, just say, please confirm no one in the house received child benefit. So if they did, it's assessed on the higher earner, irrespective of who received the child benefit. So we're assuming this does happen, it does kick in. Is there a way we can time income? So say you've got someone who's regularly got income over 60,000, and this is something which kicks in between 50 and 60,000. So someone's got income of bang on 60k. Could you alter their income so that one year they have 50,000, the next year they have 70,000? That means they don't get that child benefit clawed back every other year. So they're 50% better off than they were. If they can't alter the timing of their income, can they use pension payments or gift aid to come to the same overall effect? So if someone's just got a salary, they can't really choose to not get paid their April salary and get it paid in May every other year. What they could do is put a lumpy pension contribution in every other year rather than a small amount every year. Now, obviously, there are investment angles to that, but I'm not qualified to tell you about those. The break-even point, by the way, of paying into a pension is having 8 children. If you've got income of £60,000 and you've got 8 children, you'll be better off if you pay £10,000 into a pension, but you'll be too tired to work that out. If you've got 2 children, which is perhaps a more standard number, I don't know what the average is these days, you could put £100 in your pension scheme at a cost of £42.12, taking into account normal tax relief and getting some of your child benefit back. This is someone who's in that 50 to 60k bracket. Obviously, if you're over 60k, you've got to get down to 60 to start with. Could they use childcare vouchers? So let's go back to our earlier point. You're doing someone's tax return. They've got some kind of childcare responsibility because they've got child benefit in the house. Well, actually, is there a way they could be, knocking some of their income out of exemption? Actually, they might have a double whammy. That might stop it being taxable salary and bring their taxable income under 60, and they've got some tax-free income. So, worth asking a question. Student loan. This is one we get wrong when people bring their stuff in January. Does the client have an income contingent student loan? It's easy to miss, and it's easy to look silly. As I say, especially close to the deadline, you're so concentrated on getting the tax right, you may not stand back and think, is there also student loan? And what happens here, you miss it off, the client then gets a letter saying, oh, we've amended your tax return because you've underdeclared your self-assessment. It reflects badly on you. It's not really your fault, to be fair. So yeah, just be aware of it. And again, for anyone under, certainly younger than me, maybe even a bit older. No, probably younger than me. The other thing is where we've got people whose student loans are likely to finish soon, because it's pay through self-assessment on an all or nothing thing. So you're going to pay your 9% on the excess over 14,000 or whatever it is these days. if you only owe £132, but that 9% works out to be £1,200, you'll pay the £1,200 and eventually at some point in the future, you'll get the difference back in theory. Far cleaner, if you know it's nearly paid off, you can actually ring up a student loan company and just pay it yourself, and then you can tick the box and say, no, I don't have an income contingent student loan. That's true even if you're on a salary. There's still a lag there. Again, if you know someone's going to nearly be at the end, it's much better if they can just pay it off with a normal payment, and then they'll send a stop notice to the employer. Again, in that situation, I would do that just after payday, just to give student loans company is virtually a government body, so they won't act very quickly. Pension contributions, how are we doing for time? Do you know what I think? Get a copy of the statement, because things go wrong. The client forgets to tell you that the premium goes up each year. So you say, do you still pay £50 a month into that pension? They say, yes, I do. No, they pay £51 in, and next year it's 52, and so on. And that gets worse over a period of time. The client forgets that actually it's a company contribution and not a personal contribution, or vice versa. They pay it through the company bank account, but it goes against the director's loan. It's a personal contribution, but they say it's a company contribution, so we can miss the tax relief. Client doesn't realise it's an RAC, so particularly looking for people who are over a certain age. RAC is not just a breakdown service, it's a retirement annuity contract. So this was certain pensions taken out before 1986, I think, from memory. Someone might correct me. And they're paid gross rather than net of basic rate tax. They go on a different box on the tax return and obviously come with more valuable tax relief, because for a basic rate taxpayer, they're still going to get a direct tax reduction. End of the day, in the same position, but you're getting the relief through your tax return, not at source. And consider the annual allowance, so the annual pension allowance, which is gone down from 220,000 to 50,000 to 40,000 to even smaller amounts, depending if people have drawn flexible benefits. Again, this is something that's in that kind of hiatus, let's see if it gets brought in bit that was going to get brought in because of the snap election. Do consider people's brought forward pension allowance, so you use it or lose it, 3 years brought forward. Employer pension contributions, nothing to do with the tax return, are they? They don't go on. So don't need to know about them. Well, it does apply for annual allowance limits. So if you've got people who are making chunky contributions and they've also got employer contributions, we might need to be aware of what these employer contributions are. The high IRC, high income excess relief charge. Again, for people with incomes of over, again, I could speak for half an hour just on this, but incomes of over 110,000 for a starting point, you would include in their earnings assessment their employer contributions to see if their annual allowance has to reduce. So it's important to know what people's employer pension contributions are, particularly if either we think there's an annual allowance issue or if someone's got a high income, we need to be asking that as a matter of course. Again, otherwise people could be getting excess tax relief and it all unwinds several years down the line and we look silly. We've got the reduced annual allowance for people who've accessed money purchase pension funds. That's £10,000. The 4,000's got 2 stars on it, because again, that was due to be law from April this year to get the Finance Act rushed through before Parliament was dissolved. That got chopped out. Now, there's an expectation that will become law, retrospective from the 6th of April this year, but currently the law says 10,000, but it probably will be 4,000. So again, someone who's accessed flexible defined contribution benefits is going to have a much lower annual allowance, be that 10,000 or 4,000. So those employer contributions could easily start to eat into that. Personal savings allowance, which basically says our first £1,000, £500 or nil if you're a additional rate taxpayer of savings income, tax-free. And then someone may also have unused personal allowance. I've put there NSSD priorities, that's non-savings, savings, dividends, that's the order you tax income in. So if someone's got a 10 grand salary, say, an £11,000 personal allowance, they've got a £1,000 excess that they can use against, if they've got no other non-savings income, which will be self-employment, rental income, etc., they carry that against their savings income. So they'd have their £1,000 annual allowance plus their personal savings allowance to use. Most clients don't have £1,000 in non-ISA. Well, I've put savings, they might have £1,000 savings, but they might not have £1,000 in interest. So you need something like £17 million in your ISA in your bank to get £1,000 now. But if we've got people with a credit balance on the director's loan account, could we be charging interest on that? Never used to be worth it, really, when you ran the numbers. But now, you're allowed to charge a market rate, and how much interest would you pay to a bank for an unsecured lend to your unquoted trading company is going to be a lot more than 0.95% that you're getting with Barclays or whoever. So, you know, what's fair depends on the company, but if you were charging 8-10%, doesn't seem dramatically unreasonable. You go and ask, but I keep picking on Barclays. I don't know why. Barclays for a loan at 8% with no security, you won't get it. So could we be charging interest on there? Downside is, although it's not taxable, you have to account for tax on it if it's anything other than a one-off payment. So it becomes what's called annual interest. You're paying it each year. You have to deduct basic rate tax from it, pay it over to HMRC, and then claim it back on the tax return. So it can end up being a lot of admin for relatively small numbers. But there is an option there to save a few pounds for the client who's willing to do the admin. So just some admin points. So I'm coming towards the end now, so should have some time for some questions, hopefully, if there are any. Check payments on account made to the HMRC online system. Again, people don't always pay what you think they will have done. They might have chosen to reduce their payments on account and haven't told you. Then when you tell them what their balance is in January, particularly for the late client who you're just trying to get paid in time, they end up with an unpaid liability and some interest. Can you reduce the payments on account after an exceptionally good year? So most of you will probably be aware that you've got a 10 grand liability this year, you're going to have a 5k payment on account and a 5k payment on account. Well, actually, the reason you've got that large liability might be because you took a huge dividend out before the new dividend rules came in last year. So actually, rather than having to overpay the payments on account and get a refund, just don't pay them in the first place. It's your right to do that. Only thing is, if you reduce them too far, you do get charged interest on the shortfall. Have you ticked the boxes on page TR6? So these are the boxes that say, do you want to include your tax that you owe this year in a future year's tax code if you do it before end of December, and if it's under £3,000 now, I think the limit is off the top of my head. And also, do you want us to adjust your code for spurious items that we think you might owe next year, which I think isn't exactly how they phrase it on the tax return, but that's the reality, which I'm sure we've all seen those. So not to say you should or shouldn't tick those boxes, because it will depend on the client, but think about whether they should be or shouldn't be ticked. And it will probably vary person by person. We normally prefer people, don't we, not to include their tax in the code because it makes it nice and clean for us working it out. But sometimes the client likes the effectively interest-free loan from the government, and who can blame them? And as I say, client preferences will vary. And a new one for last year, so that will happen this year again, is don't forget we're now putting down on our tax returns, or we should be, the Class 2 NIC liability for self-employed and partnership clients. This is one that's really easy to miss, and a lot of software isn't picking it up very well. In theory, clients shouldn't be paying this by direct debit anymore. I hear some are. So again, for those people, there's a risk they're doubling up on their Class 2 NIC. But no one should be paying their Class 2 NIC by direct debit anymore. So if you pick up anyone doing that when you're doing their bookkeeping or accounts, that's one to flag up to them, because they're going to end up paying it twice. So I think I've got a few minutes for any questions, if anyone has some.